We have a lot to talk about with Dennis Gartman, DR Barton, and Susan Lee, who's down at the New York Stock Exchange for us today. So, Dennis, that is my kind of analysis, is that whatever it is we're going through in the stock market, it's not over yet. So I guess I'll start with you on what are we going through in the stock market?
It's a bear market, Connell, and people have to understand that fact. It's been a bear market for a long period of time. Globally, stocks have been trading down for the entire year. They reached their peak in January. We're down almost 11% in broad terms since January's highs. I think people need to pay attention to the fact that what we have is volume coming in on the downside, volume wanes on the upside. More stocks are down each day than are up. This is a bear market, and you need to use any periods of strength with which to reduce long positions. Okay. No ifs, ands, or buts about it. There's your headline, and that kind of prompts a discussion we can have for the next few minutes. Dennis Gartman, this is a bear market. Now, DR, as I go to you on that, there are a lot of individual stocks that have really pulled back. I mean, we've been talking about it really for the last couple of weeks, but I'll highlight Amazon just for today because remember the pullback we saw from Amazon on Friday. Again, it was almost 8%. Today it's down. It's on track, at last check at least, to finish the day in, to use Dennis's term, bear market territory for this stock. 20% off a high. Facebook, same deal. Netflix, same deal. So, DR, take it where you want to go, but Dennis says we're in a bear market. What do you say?
Well, Dennis and I have known each other for a long time, back 15 years, and I'll have to politely disagree so far because we're down. I agree with his 11% number. I'll agree that we're down 11%. We're not in a bear market until we get down 20%, and I don't think we're going to see those kinds of numbers on this trip, Connell. Right. I think that there are some things that are telling us that we might even have put in an intermediate bottom here within plus or minus a percent or two.
And kind of try to analyze that.
Sure.
So because every time we say buyers are going to come back in the market, like this morning, for example, they start to come in, the market comes off a low. We look like, and Susan can probably talk about this in a second, look like we're in an oversold condition. We start to shoot up, and then we're selling these rallies, in particular with the big tech stocks that led the bull market that we were in. So doesn't that worry you, DR?
It does, Connell, and your point is well made. And I think there's a little bit, what I've seen in my analysis is that we've had lower volume, like on the big sell-offs that we've had recently, like on Wednesday, than we did earlier in the month, perhaps. And we've also seen in these turns that the VIX, the premium that people are paying for options, which is reflected in the VIX, the fear gauge, really isn't kicking off yet. So I agree that we're in we're in a bearish mode, but I don't think we're in a bear market, and I'm not yet ready to throw in the towel on buying some of these stocks on a pullback.
All right, Susan, so you can come in here on what you're hearing from people. I'm sure you've been doing a lot of talking throughout the morning. The VIX, by the way, the DR mentioned just under 24, that so-called fear gauge, but I don't know if you want to break the tie on bull versus bear market, but what are people talking about?
I can tell you that well, the reaction here, and I think the sentiment here, is pretty calm at this point. It's an orderly sell down, as we've seen. No one's panicking at this point.
Except
yes,
Gartman.
it's a bit of
No, I'm just kidding. Go ahead.
And we're not technically in a bear market, by the way, but, I think there's a bit of a shakeout taking place right now. Don't forget, we have a lot of geopolitical issues, and in fact, the world index, the MSCI World Index global shares are at the lowest, and they have fallen the most in, since 2011, so 7 years. I would say the U.S. has been relatively contained compared to that sort of performance. So for me, right now, what I'm seeing is people are just taking money off the table, but I don't see any panic at this point.
All right, let's dig in a little bit more, Dennis, on because you'd get some pushback on well, I'm not even going to look at Twitter, but you get some pushback from people saying, hey, listen, Gartman missed the end of this thing, and he's just upset that he did, and, he's been calling for this for a while. So what is the reason that you think that, and Susan's right, we're not technically in a bear market in terms of 20% off the highs, but what's the real big reason you think we're going there?
I think the real big reason is that the monetary authorities who had allowed the adjusted monetary base to expand from $800 billion to $4.3 trillion from 2008 to 2015 have now allowed the Treasury, the Fed, to roll off those Treasury securities. The adjusted monetary base has fallen about 15% from its highs. The fuel that had sponsored the bull market and the fuel that had sponsored also the stronger economy, and the economy is uncommonly strong, that fuel has been reduced. It has been taken away. It's like when you take your foot off the accelerator in your automobile, you tend to slow down. And that's exactly what's going on. That's the primary reason. We no longer have the same amount of fuel incumbent in the market that we had in the previous years.
I don't think it was put the exact same way, DR, but what Dennis is saying has been said by someone else. I'm thinking of the President of the United States when he's taking shots at the Federal Reserve. Every time someone asks him on a down day about the market, he says, yeah, that's because the Federal Reserve is raising interest rates too quickly. But to Dennis's point, they've been accommodative for so long, we don't have that accommodation anymore. That's fair, right?
Yeah, for sure, and I do completely agree with Dennis that the punch bowl is being taken away. I have to say I disagree with the president that they're raising rates too quickly. I think rates have been artificially low for too long, and I think that what's going on in the market, some give and take, some back and forth, is very healthy, and that we need that kind of thing. I agree with that with Dennis that we're not in a monetarily supportive environment right now, but I think one of the things that is overcome that is the extra cash that's coming in from the tax reform that is helping to offset that. Further down the road, we're going to see if this economy can stay stronger.
The market, DR, isn't all that?
It's certain. It certainly, Connolly, to your point, it certainly is. A lot of that is in the market, but I still think it's very difficult to discount back all of the future tax changes, the tax breaks that are in, discounting that back from a cash flow basis to understand what these companies are really worth. Yeah, I think that's going to continue to be a difficult thing, and I think we're going to continue to see the free cash flow that can be reinvested for future profits keep coming into these companies for the foreseeable future.